Today is Monday, the 10th of July. This is a recap for the stock market activities today. Folks, I got a good one for you tonight. The market's action today was dominated by what is called rebalancing. Rebalancing of what? The Nasdaq, the triple Qs. Why are they rebalancing? Because the so-called Magnificent Seven. The whole rally this year is based on 7 stocks until recently. Because, bull markets usually dominated by 7 stocks and that's it. But now they're becoming too big to fail. Because if they blow up, they will take everything down with them. And therefore, they know the landmines are coming from China, from earnings, from the Fed, from inflation, anything that goes wrong here. And these massive big 7 names go down big. We see a mass exodus because of whatever reason, fill in the blank reason, and folks stampede to the exit door. We could see what was supposed to be a sell-off, a pullback, morphing into a massive crash and a systemic risk event. And therefore, they're panicking right now, and they're rebalancing as fast as they can by selling these massive names to reduce their size in the index. And today we went over all of this. We discussed the strategies and the opportunities that the rebalancing will open. What to buy, what to sell, what to look for, and then some. If you happen to be a member of the channel, please check it out. If you're not, consider joining and go ahead and watch the video. But with the market analysis out of the way, let's talk about macro events that took place today, then talk a little bit more about the markets and the upcoming bank earnings. And of course, we conclude by what was supposed to be a cage match, now morphed into a cock measuring match between 2 oligarchs, Elon Musk and Mark Zuckerberg. But we start with the macro news all the way from China, where Secretary Janet Yellen, she was meeting with a lot of Chinese leaders, and basically to appease and apologize and all of that. Look at how many times she bows. She's bowing, bowing, bowing. I guess when you have the sugar daddy who buys all the bonds in this country, and they can crash our entire financial system by dumping all of these bonds, I guess we have to bow. But we know that our relationship with China is down the toilet right now. And the latest attempt by Secretary of State Blinken last time around almost worked. But of course, the moment he was leaving China, the President of the United States, Joey B., came out and called Chinese President Xi a dictator. And of course, the Chinese got pissed off again. So now we have to send Janet Yellen so she can bow and listen and tell them that we're friends, yada, yada, yada. And we both know that this relationship can be summarized pretty much by the following. I hate you, you hate me, you want to take my place in the world, but we're going to pretend to be friends right now because we got a lot of money involved. But we're trying to decouple from you. Oh, excuse me, did I say decouple? I meant re-engage with China in a new way that benefit both of us. And the Chinese, of course, are going to smile and say, yeah, get these donkeys here. Let's steal more of their products. And then we master the trade and then we kick them out after we got all we need from them. But unfortunately for China, they got a major problem. And this problem is their economy is now facing stagnation. They've enjoyed massive out-of-whack growth for years. What goes up comes down. We've been getting absolutely horrendous data out of China. Services PMIs crashing, exports crashing, and today we got inflation data, and inflation is crashing in China. And of course, your beloved propagandists in the media say, oh, maybe China's having deflation, and next thing you know, we're gonna have deflation. It's not deflation. They never really had actual inflation in China. This is not deflation. This is a recession. This is an economy dipping into a recession and perhaps years of stagnation. And the problem is that our economy is dependent on China. Matter of fact, one of the reasons why we have a stock market mania this year is the hopes of China reopening. And after the slew of data that we've gotten so far of weaker Chinese economic data, the hopes of China reopening are no longer with us. But it doesn't matter. The stock market keeps going higher. Why? Because we got a weak Fed, a coward Fed, along with the AI mania. And of course, every time we get a tick down in inflation, your beloved propagandists in the media and Wall Street oligarchs, they come out screaming at the Fed. You gotta stop now. Inflation is crashing. The lags. But then when the stock market goes higher, oh, forget about the lags. We have a soft landing coming. Who cares about the lags? The Fed can raise 1 time, 2 times, 3 times. Doesn't matter. The economy is so resilient. But when the stock market starts to trend down, all of a sudden they come back and talk about the lags all of a sudden. They talk about, oh my God, inflation is going down. The Fed shouldn't do more. Are they out of their minds? And today they got a piece of data from used cars, the Manheim Index, and we see used cars prices dipping down. But look at this chart. We have a long way to go before used cars prices go down to what is considered as normal and perhaps affordable, so you don't have to pay more than $1,000 a month on a piece of shit car. But that's it. Inflation has been defeated. Mission accomplished. Time for the Fed to cut already. The good news for the addict stock market is, believe it or not, the M2 money supply, which the Fed is supposed to be reducing, actually increased as of late. Why? Because the Fed pretty much declared mission accomplished. They paused interest rate hikes, and now they're resuming the M2 money supply. And we see equities shooting up higher, home prices shooting up higher again, the prices of services in the economy shooting up higher, and soon enough even these categories that are going down, such as used cars, are going to rebound higher. You increase the money supply out of whack? You think it's only equities prices that are going to get inflated? The sense of entitlement that we have, that we can have our cake and eat it too. Equities prices reinflating, home prices reinflating, the stuff that makes us richer. But somehow, inflation is not going to make a comeback. Somehow, all of these things are going to recover in the economy. Manufacturing, services, jobs, wages, everything is going to be beautiful and keeps climbing higher. But without inflation, magically, inflation has been eradicated from the economy. Wishful thinking. If anything, the stock market mania this year is actually predicting a resurgence in inflation. And this is your evidence. The M2 money supply is increasing higher again. But of course, leave it to the Fed zombies who are coming out of the woodworks right now. And they're all surprised. Oh my God, we're caught off guard with the growth in the economy. And oh yeah, inflation too. And the latest is the zombie from San Francisco, Mary Daly, who now says that perhaps the Fed will need to increase interest rates a couple of more times to get inflation back to the goal. And I say, it's not going to be a couple of times. It's going to be, you keep going. You keep going until either you blow something up or you increase the unemployment rate in the economy. There is no other way the Fed will be able to eradicate inflation out of the economy without one of these two things, blowing something big or increasing unemployment. In other words, a recession. But of course, the Fed, since the beginning of this tightening campaign, they've been delusional about these facts. They keep communicating to us that, yeah, they can raise interest rates higher, take inflation out of the economy without causing any harm, aka soft landing. They've been singing the same tune, but inflation refuses to go away. But rest assured, Mary Daly has the solution here. I'm going to play what she said today, and you let me know if you can understand anything she said. Take a look.
If you looked at the summary of economic projections that the FOMC put out in December, it was for forecasting slower growth than we have now. Higher increase in the unemployment rate and more slowing in inflation than we see. So the data have come in a surprising strength, with inflation persistently printing too high. So against that backdrop, you think, well, there's more that we need to do. We need to continue to raise rates in order to bridle the economy more so that demand comes back in line with supply. But in that context, we also had the banking stresses in March, and those banking stresses can act like a credit shock, and they can themselves restrain. So we're balancing the risks to the economy going forward against the incoming information, which is about strength. And I was very supportive, in fact, a proponent of slowing the pace of tightening and doing that by standing pat at the June meeting, but also recognizing, like the median of the SEP projections does, that we're likely to need a couple more rate hikes over the course of this year to really bring inflation back into a path that's along a sustainable 2% path. The important thing about all of this, though, is the word in projections is projections. Those are things that you suspect could be true, but we have to be data dependent right now to really understand how to make policy.
So this is the art of saying I don't know in about a minute or so. Maybe this, maybe that, maybe we don't know. It's clear that she has no clue at all. But they keep assuring us, oh folks, rest assured, we're going to get the job done and nothing will happen to the economy. You can bet on that. And you know what? We've been betting on that. All of this stock market mania is folks betting on the Fed taking inflation out of the economy without causing a recession. Any dent, any problem with this assumption, and you will see a massive reckoning. And here's the other zombie from Cleveland. She also says that she calls for slightly higher interest rates. Just slightly. What is slightly? 25, 50, 100? I don't know. We're just going to be data dependent. They've been saying data dependent. It's been over a year now, and they keep failing in getting the job done. Why? Because they're weak, They're followers, they're not leaders, they're not in charge, inflation is. And they're going to keep playing this game. Inflation retreats, they pause and pull back, allowing inflation to come back. Then they play catch up and they start raising again. And this game is getting really dangerous. And the reason is it's going to push the interest rate significantly higher than we're supposed to be. Had they done the job as it's supposed to be by raising rates in a shock and awe fashion last year, since they've been already too late, if they raised right off the gate by 200 basis points and then another, to 6% right away, you would have seen the shock and awe, and by this time, we would not even be talking about inflation. But they're so fixated, they're so delicate not to upset the stock market. And this is why they're too weak in fighting inflation. And in doing so, this year, they have enabled a bubble to form in the stock market. Not just a small, regular bubble, crypto or some meme stocks. No. We're talking about the biggest companies in the world. What do you think will happen if they blow up? And they will blow up because all bubbles act and react the same way. This is why they're panicking right now and doing this whole rebalancing in the Qs. The zombie from Cleveland also added that she doesn't think rates are that restrictive so far, but she only wants to increase it slightly, just a little bit of touch. And then it doesn't work and we do more and more and more. At some point, a major financial institution is going to blow up because they cannot handle these higher rates for longer. And for folks who say that the Fed is done because of this pause and somehow that's a good thing, need to remind you, and this is a really good note from BofA today, that every single time, the 2-year tops, a few months later, we get a systemic risk event. Something blows up. Silicon Valley Bank was just the appetizer. When the 2-year legitimately tops and starts to reverse, that is the moment when the ticking time bomb begins. And speaking of, this ticking time bomb could be coming from banks. What do we have this week? We have bank earnings. They start this week and go on through next week and the week after. According to a recent poll by Bloomberg, when asked what is the highest risk for the stock market right now, the vast majority, 42%, say further tightening in financial conditions. The 2-year says that we have further tightening coming. The Fed says maybe we have 2 more rate hikes coming, but that's it. The question becomes, are they really in charge or inflation is? They can say 2 all they want. They've been saying, oh, it's just 2 and then we pause. Oh, 1, then we pause. But they keep going and going and going. Why? Because they haven't done the job properly. They're so afraid that they're going to cause a recession. They're going to cause it either way. That's the bad news. The question is, do we want the recession in our terms that we can control right now, or is it going to happen on other terms by rates going too high and then something big blows up? Even Citibank came out today downgrading U.S. stocks, saying that the S&P 500 is going to pull back by about 9% all the way back to 4,000. And despite the fact that both institutional and retail investors are both chasing the mania, they all know that this is a bubble. This is a multiple expansion bubble, a FOMO rally, not based on the fundamentals. When asked in the poll, we have seen a series of profit warnings lately. Do you think more profit warnings are coming? 54% of professional investors say yes, and 58% of retail investors also say yes. And listen to this, only 29% of professional investors who've been pumping this bubble, by the way, say that this earnings season will be broadly reassuring. But hey, maybe retail investors believe that this earnings season will be good. That's why they've been chasing this stupid FOMO rally. Nope, only 27% of retail investors say that this earnings season will be broadly reassuring. Only 18% of professional investors and 14% of retail investors, a reminder, both of them pumping and chasing the mania. But only 18% of professional investors, 14% of retail investors say that earnings reports will deliver predominantly positive surprises. So why the chase? Why the stampede? The answer is it's irrational. It's monkey see, monkey do. But the chart keeps going higher and the other fool went in. Why am I waiting? I'm going in too. Straight to the massacre. And now we have bank earnings coming out. In the same poll, the question is, do you think this earnings season will confirm a deterioration in the outlook and hurt bank stocks? 54.7% of professional investors say, yes, it will. 49% of retail investors agree. Then why are you chasing? Why are you folks buying these bank stocks? If you think that earnings will actually hurt them, this is how stupid this whole thing is. Only 39% of professional investors and 40% of retail investors believe that earnings from banks will help stocks recover. And today we heard from another zombie from the Fed, Vice Chair Barr, who missed out on this whole SVB collapse, but he blames it on his predecessor. Okay, but now they're putting tough rules for large lenders. In other words, Who knows what's going to happen in the near term? But in the long run, do you want to own bank stocks? All of these regulations that makes it harder to make profits and revenues? These are for larger banks. What about the small banks? In this country, and this is a good thing, we have a lot of banks. Every other country has, 200 banks, 100 banks. We have about 5,000 banks because we got to wash all of that money. But anyhow, it's a good thing that we have all of these banks, that we don't have concentration in banks. But unfortunately, when this is all said and done, thousands of these banks are going to blow up. And we're going to end up with a concentrated banking sector, aka the whole country is going to bank with JP Morgan. We know that so long as the Fed continues to be a coward and they refuse to go guns blazing against inflation, taking charge, because God forbid it might upset the stock market, rates keep going higher and higher and higher, higher than they're supposed to be. And the result of all of that is, well, if my bank is not paying me a decent rate for my deposit, I'm going to go and buy some bonds, park my cash in a money market fund, and get the 4 or 5% plus in rates. So we have all of this exodus of deposits out of banks, which was the catalyst behind the collapse of Silicon Valley Bank. And what we know right now is rates are back at the same levels they were trading at during the Silicon Valley Bank collapse, meaning we have the same stress, but we have higher rates, and banks have been restricting lending for a while since the SVB collapse. We're about to see all of these results from these banks. If they're tightening lending, then their revenues will be down. Their incomes will be down. If deposits continue to flee while they're locked in all of these mortgage-backed securities and long maturities, and they have billions of dollars worth of losses on paper, the Fed plugged the hole for now. But the question is for how long? All eyes this season will be on Bank of America. Every other bank is trading positive year to date with exception of BofA. It's down about 14%. The reason is, we covered this in details in a previous video. They have a little over $100 billion in losses, at least on paper right now. These losses will accumulate. And if they're not lending, they're not making revenues and net incomes, what do you think will happen to these banks? They're going to be under more stress. So it's going to be an interesting earnings season. And all I got to say is buckle up. But before you buckle up, you might want to grab some popcorn here because we know what's going on with the two oligarchs who, by the way, amassed the most wealth year to date, Reverend Elon Musk and Mark Zuckerberg. Why? Because we have a mania and we have a stampede on their stocks. So they did not make all of these billions, $852 billion that the oligarchs made this year. Did they produce anything? Did they create something? Of course not. It's stampeding money by the retail mom and pops and the institutional investors who are investing on behalf of retirees. They're stampeding to push these stocks higher and higher and higher. And these executives become richer and richer and richer, at least on paper. At some point, they sell their stock. They say, thank you so much, I'm cashing out. They get rich, the investors hold the bag. But until then, we have increasing rivalry between the two. Since Elon Musk bought Twitter and promised to bring free speech to the platform, it rubbed Zuckerberg the wrong way. Because the government blamed all of these election problems on Zuckerberg. He allowed all of the spams on his platform, no fact-checking. By fact-checking, of course, they mean what they deem is right. But since then, Zucchini made amends with them. He's a good old boy now. And the problem with Musk, he's too big to fight. Not physically, but from a wallet size at least. We'll talk about the dick size in a minute, but they tried to hit Elon Musk. They tried to intimidate him. Even President Joey B came out and said we have to look into Elon Musk foreign relationships. What? The guy been sending all of these spy satellites for the CIA on his rockets for years. He's been getting billions and billions of dollars in subsidies from the taxpayer. But now, all of a sudden, Elon Musk has foreign ties that we have to look into? It's bullshit, of course. And they knew they couldn't stop Musk. He's going to allow free speech, quote unquote, on Twitter. You say whatever you want, and that includes what they deem as misinformation. We have an election coming, and that's a big problem. So how do they fight somebody like Elon Musk, an egotistical maniac? The answer is you get another oligarch, another egotistical maniac, Mark Zuckerberg, and all what he has to do is copy-paste Twitter. Boom, problem solved. All of a sudden, this new platform called Threads has amassed over 100 million users in 5 days. And this is a massive, massive threat to Twitter. Just to illustrate, in 5 days, so-called Threads hit 100 million users, faster than ChatGPT. And immediately we got the data, at least from Cloudflare, and they say that Twitter traffic is tanking. Elon Musk was too political. He pissed off half of the country because everything is political now. Even our social media. We have a red social media in Twitter, although I don't see it as red. I see it as just a platform. Everybody can say whatever they want. If you don't like it, block them, hide them, mute them, problem solved. But now we have pretty much this is what's going to happen. We have a social media platform for the right, and we have a social media platform for the left, which is going to be Threads. It's supposed to be friendly and all about facts, no misinformation at all, aka censorship. A lot of folks believe in censorship. They think it's a good thing. So it's a divided country, folks, and that's that. But it's going to hurt Twitter tremendously. Because when Elon Musk overpaid for Twitter, the dumbest business deal in history, the assumption was he's going to fix the platform and it's going to be the everything platform. And he's going to look back at it and say, hey, I did not overpay. Sure, I paid $40 billion, but now the company is worth $500 billion. Well, that's never going to happen now because half of the country will be on Threads, not on Twitter. It's impossible for the company to become that valuable. So now Elon Musk is panicking and he says, hey, stick around, folks. Yeah, you can laugh in Twitter. You can see dangerous things. You can see nude pictures. You can see hate speech. You can see whatever that you don't like. But at least it's a free speech platform. And you know what? I'm going to stick with Elon here. If I go to Threads, I'm going to have to share my entire personal life, my identity, my picture, my address, my phone number, everything. Why? I'm using Twitter to communicate with my followers, get the information out, and that's it. And Elon knows that. B, if you say something on Threads and they don't like what you said, you're going to be censored. I haven't had this problem on Twitter since Elon Musk took over. But unfortunately for Mr. Musk, this is not working out. So he now challenged Zuckerberg in a cage match. And we already have the odds. The odds favor Zucchini because he have this reptilian moves. It's really fast. You gotta bet $440 on Zucchini to make $100. But if you bet $100 on Musk, you get $290 back. If he wins, of course. But hold your horses before you start betting. It might not be a cage match after all. It could be a cockfight. Yesterday, Reverend Elon Musk trolled Mark Zuckerberg in a pair of tweets that called Meta CEO a cuck. Here we go. And he proposed a literal dick measuring contest. These are the two richest men in the world, folks. The ones who are supposed to solve all of the world's problems. They're about to get into a dick fight. And of course, James Bultard says that Elon is unhinged tonight. I guess this means Twitter is bleeding hard. He's going to lose his ass. I guess Tesla bulls better prep for the stock sales, because he needs to raise the cash. Twitter is bleeding. The cash cow is Tesla stock. He needs to sell more. Now, what I don't understand is, you know in the UFC when the two fighters get together to have their weights done and then they get the stare down and you got Dana White in the middle pretending to be tough like he's going to stop a fight if it actually happens? How's that going to go with Zucchini and Musk? So the two of them going to stand face to face, then they pull their pants down, and then Dana White bends down with a measuring tape and start measuring cocks? We got a winner here by a quarter inch. What are the odds on that? But folks, in all seriousness, what are the financial implications on Meta? Because we know Twitter is now a private company. It's bleeding in an insane way. We know that. What about Meta, though? Because if you recall, they've been spending like a drunken sailor on the so-called metaverse fantasy, and the stock crashed because the margins crashed. If you look at last year's earnings, the revenues were down by 4%, but cost and expenses for Meta were up by 22%. The result of all of this is the net income, aka profit, is down 55%. No wonder why the stock crashed. And of course, in response, Zucchini fired tens of thousands of employees. And as a result, this year, look at what happened to the stock. This is not a joke. This is not a meme stock. This is the stock of Meta. So problem solved, right? They must have solved all of these problems. We look at the latest earnings from Meta. For this year, revenue is up by 3%, but expenses are up by 10%. The result is net income is down by 24%. And this is what we're stampeding based upon. Tell me again, this is not a stock market bubble, because it's not based on any earnings at all. There are no earnings. The company is losing 24% in profits. And here's an illustration for you. Since 2016, expenses for Meta surging higher. They're spending like a drunken sailor. If Joe Biden loses the elections, he might have a job in Meta because he knows how to spend. But the operating profits are dropping like a rock. So the stock crashed because we have a margin problem with this company. Now they're spending thousands of dollars in hiring. They're hiring new talent. They're snatching former Twitter employees to build this so-called Threads, which will be a cash burn. And when are we supposed to see the revenues or profits from this so-called Threads? Who knows? But the bottom line is, Zucchini is now spending like a drunken sailor again, which will bring back the margin problem from last year. But rest assured, ladies and gentlemen, this time it is different. You know why? Because we got AI. Margins don't matter anymore. Revenues don't matter. Profits don't matter. It's all about AI. It's gonna fix it all. And with that, folks, we have reached the conclusion of this video. If you liked it, please hit the like button, subscribe, share, you know the deal. And with that, folks, this is all I got for you for now. Thank you for listening, thank you for watching, and I will talk to you again tomorrow. Good night.
Let them fight.